John Grace, President, Investors Advantage, back for part two. And remember, I am the money doctor. The money doctor is in. And we're looking at the second part of the piece of information that we find very, very interesting. And it's about learning from the past and seeing what happened when things went awry before and how we might be better prepared when things go awry again. And I like to use the example of a 8.7% earthquake, 8.7, on the Richter scale, off of Catalina. I mean, if you're prepared for it, you'll probably survive to tell the story. And if you're not, you might be a statistic. And we look at that the same way with investing. So when we look at what happened between 1928-29 and 1932-33 with the Dow Jones Industrial Average, that was the stock market at the time, we can see a heck of a run-up, 1929 to about midway through 1930, where the Dow peaked at the level of 381. And then it had a 40% drop. So that it dropped from 381 to about 224. We're going to talk about percentages, and then we're going to look at what that means in terms of dollar amounts, okay? Because some people like it one way, some people like the other. We'll do both, all right? It's not either or, we're going to do and. And then we see it drop from 224, had a rise, a nice run up about 29% to 274, and then another 86% drop down to 41 on the index, somewhere between 1932 and 1933. What that means, folks, is that left the investor at that time with 10 cents on the dollar. Another way to look at it was a 90% decline. So take the amount of money you might have today, and let's suppose that in a relative short period of time, 2-3 years or so, you experience a 90% decline. $100,000 went to $10,000. $1 million, let's say you had $1 million in 1929, a heck of a lot of money, but you weren't around. That's why this is hypothetical. So if you had been around in 1929 and had $1 million, obviously you would have been well-to-do, very, very well-to-do. But imagine how you would feel if you saw in a very short period of time your $1 million drop to about $108,000. What kind of decisions do you make at $1 million? As compared to what kind of decisions are you left to make with having $100,000? Now, we'll get into this a little bit more in part three. The good news is that those who believe in holding and hoping or holding their portfolios, they got back to even, but it took about over 22 years to get back to even. Here's the thing. You're needing to live off the income from $1 million, all right? You never imagined a 90% decline. We're assuming you never took a withdrawal from that account over a 22 year period. Who can do that? I can't think of anyone. Can you? No, neither can I. And it means that just to get back to even, you need 1,000% to get $108,000 back to $1 million. It eventually does that, assuming that we didn't take any withdrawals and we kept the money fully invested in equities over a 22 year period. There might be a better answer than that. Stay tuned for part three.